Have you ever found yourself working so hard, busting your butt, and yet at the end of the day, you cannot find out what's going on with the money? You're just not pocketing the money that you thought you should be making. Hey, badass business owners, my name is Tammy, and I'm here to help you grow your business, but more importantly, to become more profitable. And one of the biggest mistakes that I see with a lot of small business owners is they're failing to pay themselves correctly in their business. So what I thought we would do is kind of walk through this, so this way you can make sure that you're not making the same mistake that a lot of people are making. And it all starts with understanding that you wear two hats in your business. The first hat that you wear is as the employee. And this is where you're getting paid to do employee type work. And then the second time you're going to get paid is if your business is profitable, and then you're going to get paid as the business owner. But unfortunately, a lot of you are thinking you're being paid as the business owner, and the reality is you're just taking employee wages, and your business really isn't profitable at all. And we're going to talk a little bit more about this because it's really important that you make sure you're getting paid for both things that you're doing. You need to understand the difference. So this way you can say, yep, I made X amount from being an employee in my business and my business was profitable and I took this amount of money. But let's first talk about how most people tend to look at their money. What they end up doing is they sell stuff, they pay for the materials, then they turn around and pay their bills, and then they pocket the rest of the money. And they're like, hey, I made a profit. This is what I did. You know what? I took in the money. I paid for the stuff that I needed to use, made sure that I paid all the bills for the business, and boom, this is what I've got. Well, it doesn't quite work like that. It's similar to that, but it's not 100% the right way to be looking at it because it's going to end up costing you a lot of money over time. Because here is the problem. Most of you are not accounting for this employee time. What you're doing is you're just, like I said, selling stuff, paying bills, and buying materials, and then thinking that's your profit. But at no point did you ever take in consideration when you're doing your pricing the employee you to get paid. Your cost of goods for most of you need to include some employee pay. You should be paying yourself for any labor that is used for either making the products that you sell or for providing the service that you have. You know, if you just buy something and turn around and sell it, there's no labor involved. But if you have to buy stuff, put it together, then sell it, there's labor involved. If you have to install something or provide a service, it cannot be done without you. Therefore, you would have to have an employee do that. And that also should have labor. So if you have to make your products or provide a service, there should be labor hours that are included in all of your pricing. And I've got other videos on this as well. You want to make sure that you check them out. But this is an area where a lot of people drop the ball, and this is why they don't get paid, because you need to make sure that your pricing has this inside of it. It is a core part of your pricing to include labor hours. Now we're going to take a look at an example really quick. All right. So let's just say that you have material costs of $50 and you decide that you're going to mark it up 100% and you're going to sell it for $100. And then what happens is people get excited thinking, oh, I'm going to make $50 on this. And then what happens is, unfortunately, they discover later that they really only made $15 if they're lucky. So what happened? Well, two things kind of happened. The first thing is they forgot all about their expenses. They forgot they have other bills in their business that they need to pay, whether it's gas, insurance, whatever the case may be. But the other thing they forgot is they forgot about this labor that I'm talking about. And what ends up happening is they end up having to spend the money to pay those bills, and the money that they thought they were going to make, they weren't. In matter of fact, that $15 was really what they were paying themselves as an employee. They never even got around to being profitable based off of how the whole thing worked. Had they factored in some type of labor per hour, they probably would have made some money. And you do that by giving yourself a fair wage, not $50, $100 or anything like that. But if you were to pay for someone off the street, what is a fair wage? Is that $15, $20, $25? What is that fair wage? Had they done it, they probably would have added, for example, an additional $20 to that 100, and now they would have factored in for the labor, and they would have had an additional $20 in profit. They would have made the $20 for the employee time because they booked that in there, and the business would have still made the $15 after it had paid all of the bills. So now they would have at least been at $35, nowhere near the 15, nor the 50 that they thought they were going to get, because they just didn't put all the information in when they were doing their pricing. Now, it's really important that you also remember, sometimes when people go, oh, I'm going to make a profit of $15. No, your profit has three jobs that it has to do. And the first one is it has to be set aside, some of it for taxes. Some of it has to be set aside to reinvest back into the business. And then there's money left over for you to take an owner's draw. So it wouldn't even be the full 15 in our example here. It would be some of that. 5 of it would have to go to taxes, 5 of it to put back into the business to buy more materials, whatever the case may be. And then finally, you might get an additional $5. So guess what? You're making even less money as the business owner. See, because here's the cycle that a lot of you guys are on is you pocket the money, you go do the sales, and then you pocket the money. And you're like, oh, I made all this money. But then you end up putting it back because you have to buy stuff for the business, right? This is where those retained earnings come in. But instead, you just take the money that you just gave yourself and you give it right back. And don't say you don't, because I help a lot of people with their bookkeeping, and people are famous for doing this. They'll pull out money, then they'll turn around and put money back in because they forgot they have to go buy something and they drained the bank account. And then the next thing you have to do is then taxes show up and someone tells you owe $1,000, $2,000, $5,000, whatever the case may be. And now they're scrambling because they put no money away for taxes because once again, they didn't make sure their profit did its 3 jobs. You need to have a plan for all the profit that you make. For all 3 of these things, it needs to be part of it. Once again, this is why your pricing is so important and why it's important that you understand that you need to be paid for an employee and for the business owner draw that you're going to take if the business is profitable, because so many of you are doing it all wrong. You're just taking the money and then having to put it all back and scrambling for everything that you're doing, which is why it's important, like we just talked about you being paid as an employee, because your business profits are probably going to be a lot less than what you think, which is probably what some of you are running into when you're thinking you're going to make a certain amount of money and you don't. Now, another question that I get all the time is, okay, great, Tammy, I get it. I understand. I need to make sure that I'm booking my labor, my pricing is right, but how do I take the money? Well, that really depends upon your business and how it is set up. And we call that your business entity, and each business entity is taxed differently. So the way you take the money out is going to be a little bit different for each of them. So what we're going to do is we're going to talk about that a little bit, but it's important that you understand it doesn't matter how you take it out. When you take it out, you are going to be taxed on all the money you make as a business owner. The IRS doesn't care about your 2 hats. It might, in some degree, because you're going to be taxed differently on those depending upon your business entity. But at the end of the day, any money that you personally take out of that business or your business makes is probably going to be taxed in one way, shape, or form. So it's important you know that. And they're going to tax you on all of the money that you make. So you need to be prepared for that. Now, I need to put this disclaimer in. I am not a tax expert. So please make sure that you talk to a tax expert in your local area because it's really important that you understand how you're going to be taxed on all the money that you take out. Now, with that said, let's take a look at the different types of businesses that some of you guys have. The majority of you probably have a doing business as, which is just, you just started working under a name and you're what we call a solopreneur, and you just go out and you slay dragons and you take the money, and there is no business entity. You haven't filed anything with the state. You're just doing business a certain way. In which case, what's happening is you can take money out at any time. It's just an owner's draw. So if you want to make sure that you're separating out your employee time that you've booked and then your business profits, just to kind of see what's going, you can do an owner's draw for the employee money. Like say you're going to pay yourself $500 a week, $1,000 a week, whatever the case may be, you can just draw that money. Then you wait till the end of the month, see how profitable the business is, and then you can take out the rest of the money that you're going to take after you do your 3 things. Once again, you're going to make sure you got money set aside for your taxes, for retained earnings, and then you're going to take out the owner's draw. Just remember, your profits technically are all of this money, but you're just separating out some of that money to say, I'm going to make sure that I get paid first as an employee. And then if there's money left over at the end of the day, that's where I'm going to get this owner's draw. So just keep that in mind. All right. Hopefully it's not too confusing. Now, if you have a single member LLC, which means you're the only one under the LLC, it's treated very similar. Now, by the way, this means you're not an S Corp. If you're an S Corp, trust me, you'll know it. So don't, if you're like, what the heck is an S Corp? Am I an S Corp? If you don't know you're an S Corp, you're probably not an S Corp. All right. You're probably just a regular person who went out and got an LLC and you started doing business. In which case, it's very similar to the doing business as. You're just going to be taking money out. I'm going to take the money that I want to take out every week from me being an employee in the business. And then at the end of the day, when the business is profitable, you're going to pull out the rest as another owner's draw. Very similar to what we just talked about with the solopreneurs. Now, where some of the confusion comes from is if you're a DBA or a single member LLC, you need to think of it this way. The government just thinks about your business is just a pass through of income to you. And it's just all lumped onto your your 1040 for the money that you make. Like if you were to have a W-2 form, it's just taxed as regular income, and they're just going to tax you on all the money that the business makes, and no matter what money that you take. At the end of the day, they're going to take your sales minus your cost of goods, minus your expenses, anything that you can deduct that's legal, and any money that's left over, that's what you're going to get taxed on. That's basically how it works with these two particular layouts. Now, if you're in a partnership with somebody, whether it's 50-50, 25-75, it doesn't matter. If you have a partnership, most cases you're getting paid what's called guaranteed payments for your employee time. Hopefully that's something that you've negotiated. For example, maybe it's 75-25, where a 75% person owner does all the work. They're the employee of the business. They go out, they slay dragons. The other person is financially, they're behind the scenes. They're just help guiding, adding money, whatever the case may be. They probably won't have any guaranteed payments because they're not working in the business, but the person out there slaying the dragons doing the work is probably told, hey, you're going to make $500 a week, and they're going to get a guaranteed payment. Then at the end of the day, whatever profit the business has, that is in turn split out with the partnership, and everybody's going to make that money there. Now, it's a little bit different because it's really important that this is spelled out in your partnership agreement. So if you're in a partnership and you do not have a partnership agreement, please make sure that you guys put one together. So this way, the person who's in the business doing the work is getting paid as an employee for the time that they're working, and then they've got the money that that they're going to get for part of the split at the end of the day. There's some tax forms and stuff that a tax person is going to work with you on these things, but I really encourage you right now that if you guys are just splitting everything and you're the one working in the business, you really should be making money as part of that partnership for the employee time that you're doing, and then you guys split what's left after that. It's not as fair if you're doing all the work and then you guys are splitting it. So whatever you guys decide on, it's up to you. But I would make sure that you have a partnership agreement in place. Now, if you're an S Corp or a C Corp, you're going to know it, okay? And you guys are taxed completely different because you are actually an employee of your business, because the S Corp or the C Corp stands on its own. So you get paid as an employee, you're on payroll and all that good stuff where you take out the taxes and everything else. And then at the end of the day, the business itself is taxed, and the money that you take out as your distributions are also taxed. I'm not going to spend a lot of time on this because very few of you are into this. But if you are, your CPA can really make sure that they explain this to you. But you probably already know it because you are on the payroll of your business more than likely already. If there's anything, there's more S Corps out there than there's anything. And usually that kicks in when you're making a certain amount of money because it just makes sense because you don't pay as much money for some of your government taxes and stuff like that. So it's a really good thing to look at when you start making some good money. But at the end of the day, ultimately what's important is ask yourself, why did you start your business in the first place? Was it to be broke, to be stressed, to be overworked? Hell no, that is not why you started the business. You started the business because you wanted to be financially free, you wanted to have more family time, and you wanted to be in control of your life, not the business in control of your life, which is what's happened with a lot of you. And when the business is running you, a lot of times it's because you're not set up the right way. You may not have the right processes and a whole bunch of things, but a big part of it, if it's a financially side of it, it's because you're not paying yourself correctly in your business. You're not making sure that you're making the money that you should be making, and all you're doing is working a lot of hours and you're not really making any kind of money. I could go on and on about this subject, and I will continue to make other videos and other podcast episodes where we talk a lot more about this, because it all starts with you making sure that you're getting paid. And if you can make sure that you're getting paid, now you can start making the type of money that it is that you want to be making. Because I really want to make sure that you understand that you have to be paid correctly in order for you to want to even continue with your business, to be able to make the kind of money that you want to make, and to be able to have the life and the reason why you started the business in the first place. And first you have to understand it, then you have to make sure your pricing is covering it the right way. And like I said, I've got other videos on pricing that, I'll put some videos for you to be able to check out on that. But I'm going to take more and more time on these videos to be able to help you understand the business numbers of your business and how you make sure that you're getting paid correctly, and how you make sure that you're priced correctly, and how you make sure the flow of money through your business is doing the right way. So please make sure that you hit that subscribe button so that you don't miss any other videos, because we're going to go really heavy over the next few weeks and months to really dive into that even more, because I want you to be a profitable small business owner. And with that, I'm going to get out of here, and I will talk to you next time. Bye for now.